Oil at $200 a barrel is not a worst-case fantasy. It is a logical outcome of a war that is already underway. Today, we are going to trace exactly how we get there, and what happens to the global economy when we do. Last time we covered the geography of this conflict, the Strait of Hormuz, the GCC, and why that region holds the American empire together. Today, we go deeper. We focus on one number, one price point that keeps finance ministers and central bankers awake at 3 in the morning. That number is $200 per barrel of oil. And by the end of this video, you will understand why it is not just a number. It is a death sentence for the global economy as we know it. Right now, oil trades at roughly $90 to $95 per barrel, and that price is already causing real pain for ordinary people, showing up in electricity bills, grocery prices, and everything that moves through a supply chain powered by energy. For context, back in 2020 during the COVID lockdowns, oil briefly went negative, minus $37 a barrel, because nobody was driving, nobody was flying, and demand collapsed overnight. The modern trading range has sat between roughly $20 and $150, with the all-time record of $147 hit during the 2008 financial crisis. $200 would put us in territory no one has ever navigated. The reason we never got there before is that every time the Middle East caught fire, every war, every revolution, every crisis, the Americans stepped in and stabilized it. They kept the oil flowing, kept the shipping lanes open, and told the world not to worry. But here is the problem that changes everything in this conflict. What happens when they cannot do that anymore? When the war moves too fast and runs too asymmetric for any stabilizing force to contain it? That is the exact scenario sitting on the table right now. Look at this map, 33 kilometers at its narrowest point. That is the Strait of Hormuz, and through that channel flows 20% of all the oil traded on the entire planet. A waterway you could almost throw a rock across controls the energy supply of the modern world. And that is not an exaggeration. That is the most exposed geographic vulnerability in the history of human civilization. Now, here is the game theory question we need to ask. If you are Iran, fighting a war you believe is religious in nature, a war you are willing to die for, what single move causes the maximum damage to your enemy while costing you the least? Closing that strait, not defeating the American Navy in open battle, just making the strait too dangerous to use. Seed it with naval mines, and no tanker captain on Earth will sail through, regardless of what they are being paid, because one mine turns a $200 million vessel into wreckage. Combine that with shore-based anti-ship missiles buried in the Iranian mountains, the Noor and Khalij Fars weapons built specifically to sink large ships in confined waterways, and the strait closes without a single conventional battle being fought. The moment that happens, oil does not gradually climb to $200. Traders price in fear before the first tanker even gets hit. And in a panic market, people will pay anything. $200 oil does not mean you pay more at the pump and life continues. What it triggers is a cascade that hits every layer of the global economy at the same time. And the sequence moves like this. Energy costs explode first, pulling everything else with them, because oil runs underneath the entire production chain. Fertilizer for crops comes from natural gas, trucks run on diesel, refrigeration draws from electricity grids partly powered by oil. And when the base input doubles in price, food, electricity, and transportation costs all follow. Economists call this cost-push inflation. It is the kind that cannot be fixed by consumer behavior because it originates in production, not spending. Central banks then face a trap with no clean exit. The Federal Reserve and the European Central Bank have already spent years battling inflation by raising interest rates. And then an oil shock arrives that pushes prices higher still. Raise rates further to fight it, and the economy crashes under the weight of borrowing costs. Accept the inflation and watch the currency erode. Neither path leads somewhere good. And that paralysis is not an accident. It is a feature of the strategy from Iran's perspective. The stock market collapse comes next, and here is where it gets genuinely dangerous. The GCC nations, Saudi Arabia, UAE, Kuwait, hold trillions of dollars in American financial markets. Investments that have been growing since 2012. None of that matters once their oil fields start burning and their desalination plants take drone strikes, because at that point they need liquidity fast. They start selling their American positions. Prices drop. Other investors read the drop as a signal and panic, and the sell-off feeds itself. That crash does not originate inside America. It gets imported from a war 10,000 kilometers away. What follows the crash is the collapse that no American politician wants to say out loud. The entire value of the US dollar rests on one arrangement. If you want oil, you pay in dollars. That is the petrodollar, and it is the foundation of American financial power. When the oil stops flowing and the GCC can no longer guarantee supply, Japan has no reason to hold dollars. China has no reason, India has no reason, and the moment they stop needing them, the dollar loses the one thing propping it up. The American empire is not built on military hardware alone, it is built on currency, and the currency is built on oil. The countries that suffer most in this scenario are not the ones people in the West tend to think about first. Japan draws 75% of its oil from the Middle East, South Korea over 70%, India around 60%, China roughly 40%. These economies take the first and hardest blow. Japan's Prime Minister has already stated publicly that a closure of the Strait of Hormuz would drain the country's oil supply within 8 to 9 months, taking the third largest economy on Earth down with it. India enters the crisis from an already stressed position, with food security concerns that predate this war. At $200 oil, imports become unaffordable at the national level. The rupee collapses, inflation runs into the 30s or 40s%, and social unrest follows among 1.4 billion people. Not a political inconvenience, a humanitarian catastrophe operating at a scale difficult to comprehend. China has prepared more than others, stocking strategic reserves and locking in Russian oil supplies, which buys time but cannot replace 40% of national consumption overnight. Europe's position is arguably worse than any of them. After cutting off Russian energy because of the Ukraine war, European nations replaced it with LNG from America and supply from the GCC. That means both lifelines now run through crisis zones simultaneously. A cold winter without energy in Europe does not just threaten economies, it brings down governments, and it creates the political conditions where extremism fills the vacuum. That is how democracies collapse. Not through invasion, but through cold rooms and empty shelves. The most important question now is whether any rational player in this conflict can pull the situation back before $200 becomes reality. Working through the game theory honestly, the answer is not encouraging. Iran is committed, in the full religious sense of that word. They are fighting a jihad to avenge a killed supreme leader. Their population demands it. And closing the strait is the most powerful weapon in their arsenal at the lowest possible cost. That move does not require deliberation. It is the obvious dominant strategy. America can attempt to hold the strait open by force, positioning carrier groups and running minesweeping operations. But every day those carriers sit in the Persian Gulf, they become the target. An anti-ship missile costing $500,000 aimed at a $13 billion aircraft carrier follows the exact same asymmetric logic as a $50,000 drone against a $1 million interceptor. The math runs against America in that exchange. The only path that avoids $200 oil is a negotiated ceasefire, and that path is politically closed from both directions. No leader in Tehran can stand in front of a population demanding vengeance for a killed supreme leader and propose a deal. The political cost is execution. No American administration that publicly committed to this war can walk away without triggering a collapse of credibility. Game theorists call this a commitment problem. Both sides have locked themselves in so completely that rational de-escalation has become politically impossible, even when both understand the cost of continuing. And that kind of trap is the most dangerous structure in international conflict. Let me bring this together. A specific sequence of events already in motion leads directly to $200. Close the strait, trigger global inflation, crash the stock market, collapse the petrodollar, and end American economic dominance as the world has known it. What makes the Iranian strategy genuinely difficult to counter is that military victory is not the point. The point is making the conflict expensive enough that the global economy fractures before Iranian society does. And a population that believes in martyrdom holds that kind of endurance advantage over a West built on comfort and stability. Next time, we turn to China, because China is the wild card that changes the entire calculation. Beijing could end this war tomorrow if it chose to, or it could sit back, let America bleed, and watch the shift in global power happen without firing a single shot. We will use game theory to work out which choice actually serves Chinese interests. Be here for that.